afternoon, Kalispera Anthropos, and welcome back to O Economica, all about economics and finance. So if you're new around here, please subscribe to the video, to the channel. And today, as usual, we have very interesting content, and I invite you all to watch this video, especially if you are in the business of the buy-to-let industry within the UK. Please stay and watch the whole content, because I'm gonna go through the wider functioning of the banking system in the UK. There are so many moving parts, and how interest rates are going to affect the ability of borrowers to service their mortgages, and how much mortgages may go up when their fixed rate term expire. So this video content is really crucial, and by no means is perfect, but please watch the video, because for many reasons. First, it's a practical things like buying a house or having a buy-to-let business, and so there are also a few how can I say, alarm bells that are ringing in my models, which there may be something that is not quite good. On the other hand, because it's there is so much involved in this market, because the housing market in the UK, it's 1.6 trillion pounds, okay, of outstanding housing finance advances which are into the system, and it's around 12,390,000 accounts, what it means that there are more than 12 millions actually open live mortgages in the UK banking system. The total amount of this finance, it's 1.6 more than 1.6 trillion pound. That's the size of the housing market finance in the UK, which is very, very, very sensitive to interest rate, because it is the primary tool that can reprice the mortgage monthly installments. The installments can become more expensive, can go up in cost, or can go down in cost according to how the Bank of England and then the commercial banks change the tracker rate. So there is the BBER, which is the Bank of England base rate, and then on top of the Bank of England base rate, there is a markup that is applied by the banks, charged by banks, as a markup profit or cost, is to provide the financial product to buy a house, whether it's your first house, you are remortgaging your house, or you are buying the house to let it out to other tenants or families. So the first thing that I want to say, and it can be very controversial, having seen how is the situation now, and we will go into details, so please stick on, watch this video. I think that the Bank of England needs to cut rate, needs to find a method to cut the base rate, because although inflation is going out of, it's not at 2%, okay, the Bank of England needs to find a method to reduce the cost of borrowing, because the longer this situation goes on, and if there is a risk that the Bank of England will be forced to add 0.25%, so as to set the bank rate from 3.75 to 4%, that will have a spillover effect on the borrowing rates for people who need finance to buy a house, or they need personal loans, also corporates like businesses who need to, small and medium enterprises who need credit from banks. When they ask for a line of credit, or they have to refinance their line of credit, interest rate has gone up, so it means that the cost of that credit is much more expensive, and so that can push way too far the leverage cost, the finance cost for businesses and households, and buy-to-let landlords. So as an example, if the Bank of England decides to go from 3.75 to 4% base rate, and let me take the base rate that the banks ask for financing or refinancing a mortgage goes up, okay? Because the base rate for first-time buyers, it's capped at something like 5.5%, 5.6%. But the overall cost of finance, the APCR or something like APR, it's around 5.5%, 5.6%. But if the base rate goes up by another quarter of a point, then that when the 2-year or the 5-year fixed rate expires and needs to be refinanced, that APR of 5.5 goes to 6%, which means that the average monthly installment, it can become more expensive of north of £100. When instead, the buy-to-let market, it can face way more difficulties, because when the rate expires, when the 2-year fixed term of fixed mortgage rate expires and needs to refinance, needs to be rolled over, you're not talking about 5.5 or 6%. You're talking about 7.6, 7.7%. And if the base rate goes up, you would be probably expecting something between 7 to 8%, which means that the monthly installment costs could jump by £350. So if a buy-to-let landlord was paying £1,200 more or less a month for a buy-to-let property, if you add on top of that 350, you are going to see the monthly cost of the buy-to-let property going from 1,200 to 1,550, 1,600, which means that if I have to pay £1,600 for my buy-to-let mortgage and my investing property yields a rent income of less than £1,600, then I'm in negative equity. So I'm losing money on the investment. That's a huge, huge thing that if you are a buy-to-let landlord or if you are the bank, you need to consider. So the sensitivity of the housing market to interest rate, it's really it's paramount. It's very, very it's really important. So to have a precise idea, okay, I took a Barclays document where we can see how this thing works. So you have your 2-year or 5-year fixed rate, and then this rolls over and you need to refinance this, okay? So you have the BEBR, which is the Bank of England base rate, which is 3.75. But if this BEBR goes to 4%, then refinancing, rolling over the house finance, it becomes more expensive because you have the offset tracker at BBR, which is variable, plus 1.99, like a 2%. Okay, so the APRC cost, it's 5.85, really close to 6%. Okay, so if the Bank of England decides to jack up rate to 4%, it means that your mortgage cost will go to minimum 6% plus, which means that the monthly installment can increase by 150 pounds for a normal first-time buyer or residential house finance, which can be a couple or anybody, or remortgaging your house, so forth and so on. Okay, so that's the first thing. So if this BEBR, which is the Bank of England base rate, which is currently at 3.75, 3.75, the Bank of England sees that here comes into the picture, macroeconomic picture, comes inflation and government spending and energy market, energy cost. If inflation is persistently above 2%, okay, now it's 2.9. The Bank of England, it's 3.75. So still it's in the clear. You have interest rate which is greater than the rate of inflation. But if this costs, this government spending, fiscal deficit, the fiscal deficit, it competes for credit. So in plain terms, the government wants to borrow, the businesses needs to borrow, the financial markets needs to borrow, the household needs to borrow. The supply of money is limited. There are too many people who are asking for money. The interest rate goes up. So sensibly, the government should say, okay, perhaps we cannot compete for the money supply because this is going to push up the cost of borrowing also for us, that we have to issue government debt. Besides this, there is inflation, which is a cost push effect on interest rate. Do you understand me? Is it that clear enough or not? So you have people who are competing for the money supply, and so the Bank of England needs to control this stuff and say, okay, they already are at 3 3/4. If you push too much this thing, something is going to break, and this is going to ripple through also into the housing market. So this is also a question of consumer behavior, of housing market behavior. Okay, first things first, the government, they need to see how reduce their cash flow needs. They must rein in the deficit, the fiscal deficit, in some sort. And they cannot tax, because the cost of finance and inflation, they are already high. If you tax more, the economy goes into recession, and that means that you're going to have defaults in payments no matter what. Not because the interest rate is too high, but because the business cycle goes into recession. That's why I made this premise. The Bank of England must find a method to go to 3.5%. This is very counterintuitive, against all consensus. For my humble desk, the Bank of England must find a method to cut interest rate, even if there is a big risk of having a core inflation rebound. I understand that it's a big risk, and the other big risk is that you have a depreciation, the escape valve becomes the pound that deflates into the exchange rate. But it's not easy. It's not an easy situation. It's not easy for the government, because they don't have quantitative easing and they don't have zero interest rate. But we got to this point in the UK, in Europe, in the United States, which has $40 trillion of public debt, and their ceiling will be hit in mid 2027. The $41 trillion ceiling limit public debt will be struck in 2027. So there is, on the horizon, there is a treasury market crisis, funding crisis. Okay. So before you get into to that point, that's why I say it may sound something very stupid to any central banker or anybody. Okay, I take my responsibility. The Bank of England must cut interest rate. I don't give a fuck about inflation, because there are much bigger things at play. Sterling goes down, we'll absorb that. Sterling goes down, okay, we can back up that with less problems for supply of goods from Europe. Let's try to have like a play where we can reduce tariffs, bureaucracy. Let's try to help it that way. I'm really diverging from the nitty-gritty of the mechanical things. I'm trying to find, these are all normal housing finance, and it's already very close to 6%. If the Bank of England hikes interest rate, these rates are going to go up, and it's not nice for people who are buying their first home. Now, if you are a buy-to-let landlord, this is going to be very nasty. This is going to be a shock, because the overall cost, okay, the initial interest rate is 4.6, but when it's basically the 2-year or the 5-year fixed rate expires, then rates can really go up significantly to rates like 7.8%, which means that the month installment can jump a lot. It can jump by 100, 200, 300 pounds. I have no idea, multiply for the number of houses that any landlord is managing, and they have finance on that. This is really concerning to me, not to me, this is not concerning, but the overall size, the buy-to-let portion of the market, it's 260 billion on a 1.6 trillion housing market. It's roughly 14% of the overall pool of housing finance. So we are in the plus 260 billion. Okay. So when the cost for buy-to-let landlords goes up, the rent will go up. Otherwise, those buy-to-let landlords will find themselves in a negative cash flow because their monthly installment will be 1,600,000 £600 a month, but they bring in less than that. They bring in 1,500, so they are short 100. And I'm excluding bills and servicing the property and all sorts of, the boiler goes off in winter, there is no hot water. So I'm excluding a lot of side costs. But if rates go, when rates go up, buy-to-let landlords, they could find themselves in negative cash flow situation, which will force them to hike rent prices, which will become more unaffordable for people, which will place a constraint down the line on consumer spending. So it will be another choking point from where the economy goes into recession. So in this situation, we have multiple choking points from where the UK economy can spiral into recession. And this is not nice. This is not very nice. That's why I repeat again, the Bank of England needs to cut interest rate, because if and when rate that are 3.75%, they are set at 4%. Okay, you have the government borrowing cost goes up, which implies the tax go up, which implies GDP. I'm sorry, I'm not using the pen. GDP goes down, which implies default. Default in the private sector go up. The same mechanism, the other choking point, the same mechanism, it's for the housing market. When rates go up, BTL, the buy-to-let section of the market, which is not whole, because we have also housing developers, which are the Barratts, the Knight Frank, I don't know, all those, the housing sector. BTL puts rent up. No, we have to be precise. What happens? The buy-to-let market goes into negative cash flow. Let me do a very simple thing. So minus cash flow, negative cash flow implies rent must go up. Rent must go up. I'm really simplifying it, which implied households and consumers, which implies households and consumer spending goes down, which implies GDP goes down, which implies defaults in the private sector go up, with liquidity that basically money in circulation into the system does not disappear, but when businesses go out of business, there is less money supply, it's damaged, it's destroyed. Okay, so these are, I know it's like a prehistoric hieroglyphic or something. Okay, it's horrific to see, just on to think. Okay, there are at least two mechanisms that can currently set GDP, economic growth, into economic recession. And it's because of inflation, interest rate, and fiscal deficit, and also a lot of leverage in the private sector from the banks. They are lending too much. So the Bank of England should actually not sit and wait, but the Bank of England should cut interest rate, and it must implement macroprudential tools to monitor more strictly what and how banks and non-banks are issuing credit, whether it is housing finance that comes from banks, housing finance that comes from non-banks, so are non-authorized mortgage issuers. What is the securitization is going around, which is 109 billion of securitized stuff. And so I think that the Bank of England must become more active. They cannot only sit and wait and look at Brent futures, oil, heating oil, energy costs, and wait for inflation data and unemployment. Unemployment goes up way after you are already into recession. Before getting there, the Bank of England must cut interest rate and must activate macroprudential tools to keep an eye, to monitor really closely how the credit and the leverage in the banking sector is developing. Okay, because now we will go on the other side. So if you are in the buy-to-let business, you have enjoyed the 4-5% for 2 or 5 years, but rates can jump. You see here, BTL tracker plus the Bank of England base rate is not 1.99, it's 4.49, 4.5%. So it means that rates will go to 8.24, 7.9%, which means that the monthly installment can jump as much as £350 a month. And I repeat, there are 260 plus billion pounds of buy-to-let finance outstanding in the housing market, which it's a write-off risk for bank equity. And we will see it now, what I'm saying. So if we take these tables here, we are able to see the activity of banks, monetary financial institutions, UK banks, and other financial institutions which move money around in the UK. We are able to see how the repo market is doing. We are able to see savings. We are able to see the total aggregate of assets and liabilities in the banking sector, the overall system. Okay, so what do we have here? We have side deposit. Okay, these are the liabilities. Okay, we have side deposits, monetary financial institutions, side deposits. The latest data point is of June, so Q2 2026. Okay, so we see that monetary financial institution, they have 103 billion in side deposits as liabilities. There is, but these are all focused mainly for intra-group banks. So it's interbank, it's in between banks liquidity. Okay, so other UK residents, they have like 1.5 trillions in side deposits, which are liabilities of the banking sector. Then there are time deposits. In time deposits, there is something which is very known to anybody, cash ISAs. So what tells me that by June of this year, there were 434 billion of cash ISAs in the system. Okay, so those are real savings. It's not that much. Yeah, 434 billion may seem a lot of money. Not really, because the size, I repeat, the whole housing market, it's 4 times the size of cash ISA. It's 1.6 trillion. While ISAs, there are only 400 billion. That doesn't mean that ISA savers have to bail out the housing sector. No. But what I'm saying, the way it works, the monetary system, anywhere, United States, Europe, Australia, Japan, UK, anywhere, there is always more credit than savings. We are always way more leveraged than what is the actual real money that we have. Okay. So here we have the overall picture. What is the overall liability, overall borrowing? Okay, so we have 269 billion of repo going on, which is 5 billion borrowing from the government, other residents of other UK banks or financial institutions that they were borrowing 67 billion. UK monetary financial institution, they had 128 plus billion in repo, which is 1 week or 30 days or 60 days financial liquidity line of credit that provides the Bank of England, because the Bank of England has changed its framework of working. When they stopped the QE and they started QT, when they decided to, or they were forced to normalize the size of the balance sheet. So they were at £1 trillion in the balance sheet size. Now they are at 600 billion or something. So they sold back hundreds of billions of pounds in sovereign debt. So they shrunk the size of the balance sheet of their APF asset purchase facility. So they shrunk the size of the balance sheet, but at the same time to not send a shock through the system, which already the shock into the system, you can see it by the fact that the cost of borrowing of the government has steadily increased even after the 2022 investment fund crisis, because the Bank of England has been a net seller of government debt. The yield curve, the cost of borrowing, is constantly increased by 100, 200 plus, by 1, 2, 2.5+%. So that now the 30-year yield, it was traveling towards 6%, which is a sign of how the 30-year gilts yield is tracking very closely the mortgage market rates, and the 10-year gilt, it's 5.2, 5 point something. I will load up the page now while I do that. So the Bank of England decided to shrink the balance sheet, but at the same time they said, okay, now we provide this as a liquidity, we provide this, the repo. So they provide liquidity weekly with the repo, okay? What means that banks, they give back to the Bank of England bonds to get money, and then they pay back plus interest 1 week later. The week after, they pay back. So you have this circle of leverage finance that wash in and out of the Bank of England every week, every Tuesday and every Thursday, okay? To keep liquidity available for the banking sector. Then we have, for the activities here, because we have liabilities, we have also assets of the banks. There are CDs, which are commercial paper, certificate of deposits. These are bank accounts which yields interest, like saving ISA, but there is commercial paper which has yielding paper, or there are bonds up to 5 years, bonds of longer duration, more than 5 years. And so we can see here that we have total sterling deposits, which are 3,150 billion 738 million. On the liability side, we have this 3.5 trillion. Now, the net equity of banks, it's here. Sterling capital and other internal funds. This amount specifically captures the bank's equity, okay? Because we have liabilities, we have deposits, so between assets and liabilities, we have equity also. So if we want to derive equity, we find out that the liquid equity, the bank cushion in liquid money, which are internal funds, is 336 billion, was 336 billion. Although, yeah, I think I have here, yeah, on this table, I have assets, total UK assets, okay, and below I have the liabilities, okay. So in the liabilities table, we are able to see here the equity, the net equity that the banks hold as internal funds, okay. total liabilities are this, deposits are this, which can be cash ISAs, bank deposits, so forth and so on, financial institution deposits, also corporate, all the businesses that are in the UK, they have a bank account with a bank, those are all bank deposits. So between the deposits, the total liabilities, we have that the internal fund, it's 336 billion. Now, in fact, if we go and see here on the asset side, we have with UK Central Bank, we have here at June, bank reserves, they were 420 billion. So bank reserves with the Bank of England were 420 billion. Okay, but those are bank reserves. Those are another thing. Those are part of quantitative easing. The effective liquidity, the internal fund liquidity is 336 billion. Okay, now that's a lot of money, but for a whole monetary system, when there are trillions of pounds, when the housing market is 1.6 trillion, if something goes wrong in the housing market, then the bank, this amount, these internal funds are the first liquidity where the stress test scenario takes off money. So if in the housing market, banks were to write off 50 billion, this 336 billion will become 286 billion. That's how the stress test is run through the system. So that's why I'm saying I'm not scared that this bank equity goes to zero. That's way impossible. But there is never enough cushion that can foresee any shock that comes into the system. It can be an interest rate shock within the UK. So the Bank of England is forced to set the bank rate at 4%. And so the whole housing market goes a bit bonkers, because then the mortgage, all the customers which have to go and refinance the mortgage because their 5-year fixed rate is expired, and especially the buy-to-let market, when they go from 5 to 8.2 to 7.7% or more, there is a huge shock in the housing portfolio of buy-to-let landlords. And so you will see that there is going to be housing distress, forced foreclosure, something that we already saw in 2007, 2008. That's why I strongly think if I were to decide how to set the bank, I would cut interest rate and at the same time have in place some macroprudential tools and say, okay, guys, we need to calm down this money private credit situation. And you refine, you roll over, you keep rolling over things, but I have cut interest rate. So you have to cut your margin on top of the base rate. And so I think that with that, you will see some cost pressure coming off the economy, and perhaps it can be good for the overall inflation picture. Although on the other side, you have a cost push factor of energy cost. Those two things can balance. There are two side risks, as I said, which is core inflation could go up, but I'm not sure, because you still have a constraining factor, which are energy cost. And the other risk, it's the exchange rate risk. That is more immediate. It happens very quickly. But I would rather see a depreciation in sterling than an interest rate shock, and then you have to run the modern risk. What is the credit exposure? What is the equity cushion that banks have? And then what's going to happen? I would rather see sterling depreciate that jack up interest rate and send banks into distress, because this is not the whole picture. Okay, the banks, they are leveraged through repo, and I want to show you another things. This table here, those are the assets. So bank assets are loans. Okay, so when a bank creates a loan for another bank or for for businesses, those loans are an asset because they are a cash flow that bank earns with interest rate. Okay, so you can see that there are loans with it for UK monetary financial institution. So this is a liquidity 250, 240 plus billion pound, which is intra-bank liquidity, which is leverage, comes with leverage, which is on the form of loan. So there is interest rate attached. If the Bank of England hikes interest rate, this part is not going to suffer very much, but the cost of the credit, the credit spread widens, goes up. Okay, but these are the repo agreement as assets. But the most important thing here, advances. Okay, advances, those are encapsulate the whole credit that is into the economy. It's 2 trillion pounds. Hello, you watching the video? Do you understand? The overall amount of credit advances provided by the whole monetary financial institution, the banking sector for the UK, it's 2 trillion bobs. 2 trillion bobs. All right? Do you understand me? So these 2 trillion, they have an interest rate attached to it. It can be a line of credit for a small, medium business. Your bakery bake me a cake. You bake me a cake. I want my 50 today. I want my 50. Which interest rate you gonna get? So, and non-UK residents, which means that there are US banks or Europe, there are foreign entities like a Chinese business or somebody who comes from India, from Japan, from wherever they settle a business, they open a business in the UK, they need pounds to run their business, okay? An off-license shop which is owned by a Pakistani or an Indian, okay? They cannot put prices in rupee in the off-license shop, so they need to take money, okay? Some of those businesses, they may be American, like American candy shop or some foreign entities, right? But the biggest part it's here, it's 2 trillion. So these 2 trillion, they also become bank accounts. Do you understand how it works? So let me erase this stuff. I'll show you how it works in plain numbers, okay? Because the total of at-site deposit is money, because it's in the liabilities. These are deposits. It means that people go into the bank and deposit their cash. So when they go to the bank and say, I want my savings, the banks must pony up the cash, my friend. They cannot say, no, I don't have the cash. So that's why it's deposit that you go to the bank and you take your money out if you want, if you need it. So if we sum up, it's here, 1,820, so it's 1.8 trillion in deposits. Then there are time deposits. It's another 1.6 trillions, which includes ISA. Okay, so in plain English, if we do the time deposits, those saving accounts, plus the current account, okay, which is 1,823 billion, okay, we are this. So the overall size of deposits, it's 3.4 trillion. But the banks, they have advanced in credit this amount. That's 2 trillion. So the net figure minus 2004, still it's positive. It's 1.4, 1.5 trillion pound. Okay. I hope that all of you that are watching, you easily or clearly understood what I'm saying. These advances, these are the credit that the banks throw into the economy for anybody. You buy a house, buy a car, you want a credit card, you want to open a chicken shop franchise, anything, any sorts of credit, it's here, 2 trillion, okay? Now, to see how the accountancy works, okay? Here I have, let's say, debit and credit, like the bank account, okay? So when you go to the bank and you ask for 50K, so the bank sign up that somebody on the ledger has a debit or 50K. But at the same time, they credit, okay, it's the opposite. Okay, I'm sorry. I don't have to put a minus here. They have a credit of 50K. So you ask for a loan, the bank has a credit of 50K, which is the loan plus interest. What they do, the debit, it's actually the money in your account, because you can go to the bank, and take this cash for you. So that's, I know it's really not nice to see, but that's how credit is created. So the bank creates a 50K credit, okay, because it gives credit to you or to anybody. In the United States, you ask for American Express like fresh water, okay. Credit card is different, but you need 500K to buy a house. So they open up a credit line of 500Ks. The other side of the ledger, it's the debit. It's actually the money that you're going to, they have to debit the bank ledger, the bank book. And so it means that those money are those available to the customer to withdraw. Okay, this is very important to understand, because the advances, they become money added to the bank account of people. So loans also are on the other side of the balance sheet as liquidity into your bank account. Okay, you get money credited into your bank account because you took out a loan. Okay, so there is this subtle nuance, okay, of in the system. So net, there is 1.4 plus trillion pound in net savings of anything, which can be businesses, households, the whole thing. There are 1.4 plus trillion of savings, but there are also 2 trillion in advances, and 1.6 trillion, those are in the housing market. So the whole thing reconcile itself when we take the housing market at a glance. Okay, summary, where is the total amount, so that here we are, okay? Loan book, the loan book. When we open the loan book of the banks, it's here. In aggregate into the system, there are 2 trillion pound in advances, in credit, which sits into the bank account, okay? The overall housing market, it's this here. Total overall residential loans to individual, 1.7 trillion plus. You see how these two figures in two different data sets, they are very similar. So the biggest part, a huge, considerable chunk of the whole credit for ordinary people, it's in the housing market. And there are these 1.7 trillion, it's spread across 12.3 million accounts, which are all bank accounts where people who bought a house, they pay the installments of the mortgage. Okay. Now I wish really that I had enough money to buy a house in the UK, because it's a wonderful thing. That's why I'm saying the Bank of England must cut interest rates, because people who have made huge sacrifices and they decided to pony up 500,000, 800,000, lots of money to buy a property, a flat in London or anywhere in Britain, they paid up a lot of money. So if the Bank of England decides to push up interest rate, I think Andrew Bailey and the whole Monetary Policy Committee, they are going to do a big disservice to 12 million plus housing finance account holders in the UK, because they create equity value in the housing market. Yeah, they create wealth. And I would not run the risk of pushing up defaults more than these are now, because default rates in UK, they have been increasing quite substantially Okay, now I don't want to scare anybody, but the reason I'm saying that the Bank of England must reduce the cost of borrowing is because it's hurting people. I can see it into the data. We will see it together. Okay, I'm not making up things. Okay, and I'm not want to be like a saint. I don't want to be Carlo Acutis, or I don't want to be Robin Hood. I'm dealing with data, okay? Hard cold data. Okay, loan book, you see number of loan accounts is 12,394,000, etc. Balance outstanding, it's 1.7 trillion plus, 1,746 billion. Okay, but people are hurting. Okay, the default rates are going up. That's the main problem that I think the Bank of England is ignoring because of government policy, because this is absolutely bonkers. Because these people, they are promising that they are going to build social housing, and they are telling porkies, before they build social housing, you're going to have an housing market crisis, guys. I don't want to see that. I really don't. I'm sincere as water, as transparent water. I don't want to see that. I really don't. I don't. I would hate to see such a thing. I would hate myself to see such a thing because I can see it into the numbers and I cannot do anything. Okay, and it's upsetting. But anyway, not anyway. I want to find ecco qua. Now I spoke in Italian. So the overall, not the overall, the quantity of housing finance which it's in arrears, it has been increasing. You can see here, for example, just one of the metrics of the data that you can find. New cases as percentage of arrears stock, it's 9% per quarter, and in 2025 was 8.7%. It's close to 10%. 2024 was 11%, 12%. So there is 2023 was 15%. When immediately after 2022, you can see the dynamic here. New cases arrear, 2022, 2023, they go from 8 to 12 to 15% because that was the time when the Bank of England was still increasing, jacking up interest rate, pushing up interest rate. It went to 5%. I don't want to think how much what was the interest rate on a home buyer mortgage. That was terrible. But if we go, okay, 2007, the rate of arrear per quarter was 27%, was way big. But before we get to those levels, okay, I think that the Bank of England must stop before it gets too critical, because the percentage change, it has decreased from 15, 12 to 9% somewhere, but these are new cases which are adding up on the previous ones. So there is you see number of loan, there is already here 129,000 of loan accounts which are in distress, which is not little. Okay, let's do for argument's sake, if I take 129,887 and I multiply by standard £500,000 cost, those are 69, 64, almost 65 billion pounds. Okay, and I'm doing a very fantasy average, gross average cost. Okay, average cost of £500,000. But we want to do 129,887 multiplied, I don't know, average cost 400k. No, they're not 4 million. 400k. Still, we are talking about 52 billion pounds of distress. And when I compare the 52 billion pounds, more or less, with the internal fund liquidity, the equity cushion, which is 336 billion, then I say, oh, okay, banks will be solvent, but there is some sort of risk, because these things happen. It's not only that the banks will be solvent, it means that then maybe the dollar market liquidity in dollar funding can freeze. Okay, there can be a problem also from the United States. And so this whole equity cushion is not really so much safe as you think it is, because the shock, it's asymmetric. It comes all at once, and the magnitude, you cannot really estimate it in a stress testing, because it's never as real as the real thing. Okay, balance outstanding, we are at 15.6 billion. It's not small change, guys. It's not small change. Okay, and because not the overall thing, not the full 100% of the home, the house line of finance, it's in default. And so they basically, the bank takes back your house. But you can see here now the concerning data. Okay, in 2007, stocks of possession at the end of quarter were 5,000 units. It sold in 2008 to 10,000, 13, 17, oh my God. Almost in the first quarter of 2009, almost 20,000 homes, they were taken back by the bank. But let's focus on 2007, 5,000 units. If we move fast forward, you see the trend was 2,000, 3,000. In the first quarter of 2026, which is not 2027, it's 4,700 units. So the stock of houses that are going back to the bank, 4,700 units, it's not very distant from 5,000 units of 2007. So in proportion, the loan book has doubled, because the number of accounts in 2007 was 6.3 million. It's this number here. So on a total of 6.3 million plus, 5,000 homes, they were taken back to the bank. But today we have 10 million on the loan book, and 4,700 units have gone back to the bank only in the first quarter of 2026, because the previous quarter was another 4,700. I don't know if it's a number that sums up, probably, but anyway, it's in proportion is not the same, because this is 5,000 in proportion of 6 plus million. These are 4,700 in proportion of 10 plus million of housing finance, which are active into the system. But then again, there are more than 10 million people who have bought a house, and house developers. You don't want to send this whole thing into crisis, because then the ripple effect is that plumbers, carpenters, the construction industry, they all go into distress, because all the housing market starts to falter. So my humble desk suggestion, the Bank of England must find a method to cut interest rate. This method, it has to be coupled with macroprudential tools, because the banking sector is very, very active in providing liquidity. And there is also a lot of liquidity that comes from US dollar and euro banks activity in the UK. Okay, the euro side of things, we are here in 1.2 trillion euros in liabilities. There are 300 plus billion in assets. So there is a lot of liquidity that goes in and around the financial system, because there is the euro dollar market. So if we see the operation of the US banks, we see that we have some very large amounts. So the US banks, they borrow in sterling, quite some large amounts of money. They borrow it to also to repo, but they do a lot of borrowing in foreign currency liabilities, including euro. So they use the repo window no, this is side deposits. Side deposits, there are quite lots of money here. If we sum, these are in foreign currency, okay? So it can be dollar plus euro plus something else. It's $1 trillion in foreign currency. And you see that there is quite sizable repo activity here. There is a lot of repo. No, this is wrong, sorry. Anyway, let me sum from the top. Sum the line here. Now I diverged a little bit, but I want to show you the full picture. There are some like total liabilities, 1.7 trillion in foreign currency liabilities. If you take the whole mumbo jumbo here, US assets in foreign currency, 1.7 in assets which are in US dollars, euros. So the UK financial sector, it has a huge role for the euro-dollar market. Okay, perhaps it's more visible here. Okay, UK monetary financial institutions. Yes, here we are. We are here. You see, total liabilities is 6 trillion. 6 trillion. This is double the UK GDP. Okay, just to give you a flavor, the amount of outstanding foreign currency liabilities, including euro, monetary financial institution, excluding central banks, balance sheet, UK. This is not UK banks. These are non-resident banks, because monetary financial institutions, you see, they have 27 billion in deposits, for example, in foreign currency. These are US banks, which have 531 billion in deposits. They have here 1 trillion in repo, 1 trillion in repo activity. This is between dollar and euros, okay? So the overall deposits in foreign currency is 2.1 trillion, okay? The overall size of the liabilities is 5.9 trillion. So the overall size of the whole euro-dollar market, sort of, let's call it euro-dollar market, is the overall liquidity between liabilities and assets and bank deposits, repo markets, derivative, credit derivatives, and so forth and so on. The internal fund liquidity is 121 billion and a half. But anyway, so there is huge money flow activity between dollar, euro, so forth and so on. But anyway, I will stop here, because my humble suggestion is that the Bank of England must find a method to cut interest rate, because then the cost of borrowing or refinancing buy-to-let properties and simple residential mortgages is going to be much higher, and this will have for sure will have a negative effect on the whole economy. So the government must find a way to to reduce the rate of borrowing, and so the Bank of England on the other side must find a method to cut interest rate to 3.5%, and then try and manage it from there. Another thing that I can share with you are some sort of forecast. The forecasts are made with interest rate term structure models, which are called Vasicek and CIR models. Okay, so when I implement the Vasicek and the CIR models, and I take the Bank of England data set of the 2-year and 5-year fixed mortgage rate, okay, you see that the projected forecast, the green dash line is the CIR forecast, and the orange line is the Vasicek forecast. You see that tends to go above 4.5%. So the interest rate projection is that the base rate of interest rate of mortgage rates will go up on this trajectory. So this incorporates a Bank of England hike. You see here 20 months forecast, and these are rates either for the 2-year fix or the 5-year fix. You can see here the 5-year fix will go way above 5%. It already sits above 5%. It could go 5.5 or something. But the crucial thing is that on top of this, you need to add the tracker rate. Okay, so it will move up. It's already tracking this cost, but the forecast basically it's for higher rate. The only method the effective method to contain this theoretical projected increase is the Bank of England decides to actually do something very unorthodox and cut the base rate and manage it from there with macroprudential tools and by monitoring all the credit market dynamics for the banks, for the banking sector, private credit, so forth and so on. Because in this picture, there is also the AI financing bubble component. So I'll leave you all with this. I hope that you watched the whole video. I don't have a precise prediction of where mortgage rates will go, but the basic mechanic, the basic dynamic is that if the Bank of England moves the base rate from 3.75 to 4%, you can expect mortgage rates to go to 6% and buy-to-let rates to go to 7-8% plus. And the bill at the end of the month, the installment end of the month for residential housing buyers can increase by 150 pounds. Buy-to-let can increase by as much as 350 pounds. So I personally will never, ever be in that kind of situation, although I would love to have a property in the UK, but I obviously I cannot afford it. So the sensible thing is for the Bank of England, not for me, but for the 12 million plus people who have an account with the bank and they are paying back their mortgages and they've done what society has asked of them to do, okay, to cut interest rate. So best of all things, keep it up, keep up the good work, people, and be happy. No worries, everything will be okay.